So my channel is called Beat the Denominator because of the increase in money supply. I have seen money supply decrease the returns of most investments. And as money supply goes up, not only do you reduce your investment returns, but it also creates inflation, so you can buy less stuff. And the S&P 500 may beat in nominal terms, but it won't in real terms. You may get a nice +9, +8% over 30 years in the S&P 500, but if the US dollar supply has grown by 10 to 15% within that time, you've actually lost purchasing power. So it's a basic assumption of this channel. And my base case right now, the reason why I started the channel is that the new dollar printing rate, right, the rate at which new dollars emerge right now is about 15%. If you include both M2, which is what is discussed the most, but you also have to include euro dollars, because the euro dollars held outside of the US flow back into the US economy. So our denominator of all economic value, right, the US dollar, is growing at a 15% clip. That is my base case. And thus, if a business is not growing sales at 15%, in my eyes, it is shrinking. And you can look different statistics, but this is what happens here if you look at M2, right? So M2 grew very, very rapidly, and now the Fed is bluffing. That's another thesis in my channel. The Fed is going to get back to monetary printing because they don't have a choice, and now we've had a teeny tiny drop in money supply. But don't worry, it will go back up. It always has. It always will. No investment advice, but this is another example of another asset that is growing just as fast, which is treasuries, right? The US is issuing more and more treasuries almost just as fast as monetary printing. And there's a reason for that. Because who is a buyer? Who is the buyer of these treasuries, right? It's the Fed with base money. The Fed issues base money to buy these treasuries. So the US has been printing money at a very, very rapid rate for a very long time. It actually predates going off the gold standard. That's mostly from banks and commercial banks creating money, but also base money more recently. And how do you see that most clearly today? How do you see money supply most clearly today? Well, Charlie Munger, I like to look at Charlie Munger. Almost any currency will be worthless within 100 years, which is funny that he says that because he's very anti-Bitcoin, for example, even though Bitcoin was created to kind of address this issue. But that's an aside. Another one is, let's look at the price of a house in 1908, right? A Sears home in 1908 was $725. And by the way, some people might argue that this house is a better quality than the cost of the house today. And today, if you want to build a house like that without the land, you're going to be at what, $250,000, $300,000 for a similar house without the land. So back then it was $725. Right? Absolutely nothing compared to what it costs today. And why has that happened? Because they have printed and kept printing money, and the denominator has kept increasing, thereby devaluing us, right? Devaluing all investors. So that brings me now to Elon Musk. So Elon Musk says this in the call at about an hour 07. If you go on Tesla's YouTube channel, it says the basic value of security is a function of the risk-free rate. And then it says, well, and he chuckles and he says, we'll see how risk-free it really is, talking about Tesla's valuation. So Elon Musk, founder of X.com, later became PayPal, and he's been very outspoken about Bitcoin in 2021 and understanding money and the ledgers, and money is just a ledger, it's just writing, understanding how exchanges of economic values work. He's saying, we'll see how risk-free it really is. And Elon chuckles in the call, and then the CEO says, ooh, the CFO says, ooh, like that. And actually, if you listen another minute into the call, when he keeps talking about valuation and risk-free rates, another person on the call makes that noise. So what that makes me believe is that Elon Musk is fully aware that it is not risk-free, fully aware that the dollar is not risk-free. When you buy treasuries, You buy a contract on the dollar, right? If you're going to repay that principal to you within a time frame, it's not risk-free. It's not risk-free, even though this is something that all finance professionals learn. Every finance professional learns that the dollar, a T-bill, is risk-free. And actually, this was in response to an analyst from the finance community. So let's just unpack a little bit what Elon means, right? So what does Elon mean? Not risk-free. What do you mean the T-bills are not risk-free? Well, we have to talk about default. What would be what he means. When we mean a bond is risk-free, it means he can't lose money. But that's not true. That's a misnomer. It's not risk-free because the governments can default. And in fact, so many governments throughout history have defaulted before. I think the most recent government to default was Russia. But so many have defaulted, and there's really no two ways to default. You can default the hard way, which is you simply stop paying interest and principal, and that's less common. And then you can default the soft way, which is you borrow ever more money to pay interest on the old debt. And by the way, in most of the fiat standard way of thinking, whether it's Europe or the US, it's the governments that issue debt, right? Treasury. The government issues treasuries. And then who's buying those treasuries? The Fed or the BCE. So the Fed buys the treasury with base money. And to quote Jay Powell, how is base money created? Well, what did he say in a 60 minutes interview during 2020? He said, "Well, we print it. We just printed it. We print it digitally. That's it. Base money is just created, and then it goes to buy the debt issued by the government, and then that debt is used to pay the budget. And of course, the number one item in the budget for a lot of governments now is becoming the interest on those bonds that were issued prior. So you essentially have a soft way to get out of the debt, and I believe that is what Elon Musk is referring to, and that's the whole reason why I created the channel. When you hear risk-free, it is only risk-free in nominal terms, not in real terms. Your bank account is going to show green when you get that interest. But it's only in nominal terms. It's not in real terms. It's not in purchasing power terms, whether it's purchasing power of stuff or purchasing power of assets, right? So imagine this. A T-bill, a treasury bill, repaid by the government would be only worth 1/10 of its original value if the money supplied had increased by 10 times, by 10x. And will the money supply 10x in 30 years, say for a 30-year T-bill? I would argue it's likely. I would argue probably it will. So again, you're locking in losses. You are locking in losses when you're buying a T-bill. A T-bill is just a contract for dollars in the future. And let's look at it more clearly. Could there be other sorts of default? Like, could there be, for example, a hard default on the money? Well, let's look at this article. This is a very scary article. So, right, the debt limit, the U.S. debt limit. The U.S. has this limit in Congress that says that you have to raise the debt ceiling. Otherwise, you can't finance the government. You can't issue bonds that the Fed then buys. You can't issue those bonds to finance the government. And that's slowly happening, such that you have very scary headlines, in my opinion, that reads, Treasury taps retirement funds to avoid breaching U.S. debt limit. Wow, is there a problem in getting money out of Social Security to pay for the government expenses? Is that a problem? Is that money going to come back? What's going on here? I argue that is a very, very slippery slope. This is not what these funds are for. So we already have signs of that, signs of what's happening. I think the more historic example of issues of raising the debt ceiling and borrowing ever more money is one of my favorite ones, which is the $1 trillion platinum coin. So the U.S. Mint can print money, and that money goes to the U.S. government. That's one of the privileges of the Constitution. And so for the past 20 years, they've had this idea of minting $1 trillion coin to pay for those expenses, simply. So if you've heard of a $1 trillion platinum coin, they would just put a few grams of platinum in a coin, and they would write $1 trillion on it, and they would create new money supply like that. And it's been very seriously pushed by certain politicians. They even have a hashtag #MintTheCoin. So that's just a thing. Monetary printing would take one of its purest form if the Treasury just printed $1 trillion coin and exchanged it to the Fed for cash, right? For digital cash, and then it can use to pay for its expenses, its interest on past treasuries, etc., etc. So this is very real. And when I hear Elon laugh, and when I hear of a CFO say, "Ooh," when they talk about the risk-free rate, I think they know full well what they're talking about, which is this is not stopping anytime soon. Thus, the dollar is getting devalued. Thus, when we're surprised today at a house costing $725, when today they cost $400,000, $300,000, we're surprised seeing $700. Well, I ask you, how many millions is an average house going to be worth 20 years from now? Well, that's gonna be the same thing. Maybe not a stock because it's only a 20-year period, but over a 100-year period, as Charlie Munger says, the currency will lose 99% of its value over the long term, and that's because of this. That's because of a denominator growing. They always increase the size of a denominator. That's the reason. So I would argue that a soft default, what I call a soft default, is already happening, and that's happening because of a devaluation of the dollar. That's what's happening. That's what happened in 2020, which is why we've had a lot of inflation in asset prices is due to 2020, and the inflation in asset prices was not due to supply chain. It was due to simply the increase of monetary mass, because this monetary mass right here will stick to the hardest goods and services. So it sticks to art, it sticks to stocks, it sticks to houses. That's what it does. It doesn't tend to stick to transitionary consumer goods that are impacted by supply chain. So that's what happened here. And so I believe a default is already happening by way of devaluing the US dollar. We see this in asset prices. Home affordability, for example, just keep going higher and higher and higher. And even if inflation on a basket of goods, like the CPI is calculated, is going way down, it's not going down on housing. It's just not. And a hard default, I believe, is way less likely, because at the end of the day, they will always raise the debt ceiling. This is more of a political tactics to get bills passed that they do, that they use that threat of not raising the debt ceiling. So I believe they will most likely raise it at some point. So it's less likely, but the soft default is just as bad and just as dangerous for the value of our investments. And so I'll conclude with this: if you just own the denominator, so right, when you own an asset, when you own stuff, when you own a house, it's one house, 100 shares of Tesla stock divided by the denominator, divided by how much money supply is out there, right? So you don't own the denominator when you own stuff or when you own an asset. You own something that is divided by the denominator. But if you buy dollars and hold dollars in a savings account, or if you buy bonds or T-bills, i.e. a promissory note for dollars in the future, right? If you buy a 30-year bill, that means you get the money back in the future in the form of dollars. If you buy the denominator, you'll likely be devalued. That's what will happen. You're locking in a guaranteed long-term devaluation. No investment advice, nothing's guaranteed, but that's what you're locking in. So this is why I don't own bonds of any kind, whether it's a promise by a government or a promise by a company to repay me back my principal. I don't own that kind of asset of any kind, because I see what's happening, right? I see the money growth. Expect a big spike, perhaps in 2023, likely in 2024, when revenues that come in are not as high because there's a recession, because there's no more capital gains, and that will be the denominator. Right, so that's why I don't touch denominators. I look at companies. I look at asset. A company is an asset, right?
So companies that grow faster, that grow their revenues faster than the denominator. That's also why it's very important. It's not that I don't like value. It's not that I don't like low growth companies. Like I'm familiar to a lot of these companies. I think they're great companies. But if they don't grow their revenue by 15%, you're destroying wealth. You are drowning by the increase of the denominator. If the money supply grows at 15% and there's 15% more dollars out there, your company should at least capture 15% more dollar each year just to stay even, So that's why in this channel I focus on companies that grow past 15%. And ideally I would like to have 30%, because when I look at 30% nominal returns, right, 40% returns in dollars, I realize that in reality that's more likely 15% in real terms and in real returns. So again, I was struck by Elon Musk joking about the risk-free rate and saying we'll see if it's really risk-free, because I think I fully knew what he meant, and a lot of people think like that, and so that's the reason for the channel. So subscribe, please subscribe. I really appreciate any subscribe and any like I can get. Thank you so much for watching. None of this has been investment advice. Don't forget to like the video and follow me on Twitter if you can. I appreciate it. Thank you very much and have a great day.